What's up, everybody? Michael Silva here. Man, oh man, that 10-year yield keeps on ripping. We closed today at 4.28%. This level is not seen since roughly around 2008 when the great financial crisis happened. You can see we broke out of this bull flag. We back tested it, and this thing has been on a move higher. Which means that what? The 30-year fixed mortgage rate continues to rise there too as well, making the cost of home affordability more expensive. It's a great time to be buying a home, folks. That's why I'm buying one right now. I'm just so happy to see these rates continually move up weeks, days before I sign and lock in a rate. It's awesome. What happened today in the news? FOMC minutes came out. Inflation risk could require further tightening. The monetary policy tightening appears to be working, and they also had mentioned that they stressed that inflation remained unacceptably high, which has people thinking they may need to hold rates, obviously, for longer. We know this information. That's what Jerome Powell said. When the FOMC minutes dropped, the dollar started spiking higher, and we know that when the dollar moves up, this puts pressure on various assets, one being the S&P 500. Dollar up, S&P 500 has been going down. We talked about where it topped out over here, where the market bottomed. As this went down, the market started going higher. So is this dollar going to continue to push itself up further, making the market pull back more? It's a possibility, but this is getting quite overextended of a move. If we take a heat map view, or just a market view, not a heat map view, but a market view of various assets, which you'll see is here. I have week-to-date performance, month-to-date, year-to-date, but I want to point out something on the month-to-date. This month is the month of August. What you'll notice is we have very little in the green. Everything's in the red. The ones that are in the green is what? Boom. The dollar and the 10-year yield. The TNX is what we're using as far as the proxy goes. We also have healthcare barely there in the green too. So the dollar up, 10-year yield up. What does that mean? Well, we've been talking about that nonstop, but this is a good picture view of what it looks like when you start to see the dollar move up and how it can impact other various markets, and also alongside a rapid rate of change to the upside of the 10-year yield. If you go ahead and take a look at today's performance, out of the 11 sectors, we're pretty much all in the red again, except utilities snuck its way into the green. So that's almost 2 days in a row where 11 out of 11 sectors were down in the red. As you can see here to the left side, NASDAQ composite got hit hardest, as well as the NASDAQ 100. So tech names are the ones that kind of took it on the chin there. You can see the tech sector down 0.95, about 1%. And then we had XLY, about 1.24%. Okay, it's interesting that we see that all this red coming into play. Then all of a sudden, Goldman Sachs comes out and says that they're blaming zero-date options for fueling the S&P 500 sell-off, and the impact further amplified when market liquidity is worsening. This is funny because, well, I mean, no one was complaining when it was obviously going up, the markets, when I say that. We're going to hop into the 15-minute charts. Where did the S&P 500 close on the day? It closed basically on the daily expected move. So nothing out of the ordinary happened today. What do we got to take note? We'll take note on the next chart with the updated daily expected moves, and we'll also map out of some key levels here. So the one main key level I want to point out is the lower weekly expected move. That's 438.98. It looks like we are in striking distance of that. And then below that is going to be the daily expected move. I added some numbers here, and if you want to see a more zoomed in version of this chart, go ahead and go to my Twitter. It's linked in the description. It's the handle is Mike P. Silva. If you go there, what you'll see is a link to these charts, the S&P 500. I'll give you the NASDAQ 100, the Qs, and I'll give you the DIA too, the ones that I'm about to show you. Okay, so I have the 2 sigma levels leveled out, and what you'll see is that 95.4% onto the right of it. I added that in because 95% of the time, the price is going to close within this range. So basically, we have a huge probability that price is going to close within here. However, when we scope it in a little bit, we have about a 68% probability that the market's going to close within this range. So if we start coming outside of the weekly expected move, one, we need to obviously be careful, because if this is actually going to turn into some more sell-side activity, you know, and the market gets this number wrong, what can potentially happen is you get more selling and it really causes a monster move. But what you'll want to watch for, if that were to actually take place, is you can zoom in on the smaller time frame, say the minute or 2 minute, and you will see volume explode coming outside of these levels and breaking down. And if that happens, buckle up, it could get quite nasty. Overall, though, we've seen it price come down and we doodle around these levels. We have already been selling off quite a bit, and we've been getting kind of overextended. Overall, if I take a look at the key levels that I track, the week-to-date anchored VWAP, the month-to-date anchored VWAP, and the green one is the quarter-to-date. Then we have that purple line, which is the declining 5-day moving average. All of them, as of now, I mean, some of them are neutral, but the 5-day moving average is declining. The week-to-date anchored VWAP, you can see, got below it here, and it hasn't even tested it yet, and it is declining. So overall, the trend is clearly bearish. What do we need to see? We need to see price back above the 5-day moving average, and we need to see it flattening out to start turning back up again. It's not there yet, so you can play tactical bounces. You can play outside. If we come to the lower daily expected move, maybe play bounces into this area, or you can just ignore it and wait it out until we start to actually see bullish activity. Right? I know some people like to short. Some people don't. And if you don't, and you're not tactical with shorting, because it is a lot more difficult than just going long, if you do just trade long, you want to wait for the bullish trend to take place. And being that this is the 15-minute time frame, missing a couple of bucks just to wait for a bullish trend and showing strength, is a lot better than buying down here and then all of a sudden we crack even lower. Because remember, crashes can happen in oversold conditions. So there's a little bit of rant, but a couple of key levels. Overall, when I look at this chart, it says, just be on guard still. It's bearish trend and obviously a bearish placement as far as where this price goes. Let me fix this chart really quick. Bam. If I take a look at the Qs today did crack outside of the daily expected move as well and closed outside of it, but we're pretty far off of the lower weekly expected move. So if we're going to get a continued sell-off, it's going to have to probably come from tech, being as we're pretty far off the lower weekly expected move. The lower daily expected move is about 356. The upper is 366, and we're in that bearish trend still below the week-to-date anchored VWAP, month-to-date, quarter-to-date, and that declining 5-day moving average. The IWM, interesting here, as you can see a subtle positive divergence forming as this cracked and closed at the low for the day. We're outside of the weekly expected move, right? I will say that the S&P 500 or the SPX, those are the more significant ones because that's, the bigger product, but it's still worth noting that we are outside of this weekly expected move for the IWM, and we're below all those key moving averages and moving average and anchored VWAPs, and they are declining as it stands. So to see a bounce back within this, that could be a potential opportunity, but just be cautious, be careful, be tactical, and have well thought out stops. I will say this is not the area where I'd be shorting it just by looking at this chart. I wouldn't short outside of the weekly expected move, and I wouldn't short on a straight move down. I would want to see a bounce, obviously, of some sort, and then a series of lower highs continue to trend, lower highs and lower lows. Now, if I look at the DIA, the Dow Jones Industrial, the Dow Jones Diamond, that is also now currently outside of the weekly expected move. You can see we came down into the quarterly expected move, and then it acted as resistance today, cracked down. We're below that declining 5-day moving average. We're below the quarter-to-date, week-to-date, month-to-date, anchored VWAPs there too as well. So once again, everything from a market perspective, looking at it from these big index products, we're below key levels. The trend is clearly down. We need to be obviously careful. For those that like to look for potential bounces and opportunities, we are outside of the monthly expected moves. Once again now, for the SPX, we're not too far off the monthly 5 EMA, which is still inclining, and we're above it. And what you'll notice here is we're actually just trading inside of last month's candle still. So yeah, it's down 4% on the month, but we're still trading within last month's trading candle. So in this term, in a longer term sense, we are in a bullish trend, but we just got to be aware that we're outside of the monthly expected move, and that 68% of the time, right, you want to see price get obviously close back within it. It's currently, as of right now, the market has it wrong with a lot of time left in the month. Qs are also outside of it, and you can see we cracked through the low of the last trading month. So that's a lower high and a lower low as it stands right now, but we're still above that inclining monthly 5 EMA. IWM, it's getting below the monthly 5 EMA as it stands right now, right? That's at 186.40, and we closed today at 185.84. And obviously, we've been talking about being back in this red shaded area that's more than 20% down from its all-time high. So we're technically in bearish context. We gave more context with the IWM yesterday. So if you haven't watched that movie, go take a look at it. Once again, yeah, we're outside of the monthly expected move. Now, I wanted to talk on the secret level that we discussed that was hiding. This was back in August 2nd. We talked about ES at 44.05 down here. Remember, August 2nd, it's now August 16th. This thing has been here for multiple weeks. And guess what? The order is still there. So this is pulled from the aftermarket trading session. It's been there all day. Once again, it was 17 or 1800 orders. And what I noticed here today is that the orders were split up. This is aftermarket, so we don't know what's going to come from this, but just note that the order did split up to lower down. So we have now 950 orders here, 950 there at 44.05, and then below us at 43.90. So this supply or these orders, this liquidity has been hiding here for quite some time, and we've been talking about how they can act as magnets. The longer that they're there, right, the price will look for potential buyers. And if we don't have buyers, it's going to go to the levels of liquidity where they're hiding out. And they are hiding out right here at this given time. That doesn't mean that the market's going to bounce and rip from these levels and make new highs. That's not what that means. But what we know is that back in August 2nd, these orders have been standing. So we had to go on a little bit of defense the longer that they stayed. And as the 5 DMA was trending down, which it still currently is. If we take a look at a couple other indicators here, the summation index still remains bearish. It's back below zero. The parabolic SAR is above it. We did crack down through that oversold condition there on the NASDAQ McClellan oscillator, and this is typically where we can see some bounces occur in the near future. So this is also something to note. Also, we are getting the NYSE McClellan oscillator into some overextended territory here, right in around minus 250, as the summation index is still pointing down with the parabolic SAR above it. I also included today the SPX McClellan oscillator down here, and I'm showing you on the weekly time frame. I could show you on the daily, it'd be the same reading at minus 100, but I'm showing you on the weekly just to clear up the data a little bit, because we still have 2 days left in the week, so it's not necessary that we close down here. But just note that we don't close down in these areas very often. So dating back to 2013, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. There's only been 10 times in 10 years where we've seen the McClellan oscillator get this low of a reading and close down there on the week. So pretty oversold condition. Also, just be aware that, hey, in 2022 is when we started trading those zero-date options. And that's kind of why I included this text about they're blaming that for the more of the volatility fueling this downside. It's likely to see more upside and downside because of these, and that's exactly what we've been seeing. If you're part of the swing trading group, or not swing trading group, or the Patreon group, and you have the Discord sunk up, I did share some updated zones that I want to share with you today. If you're not a part of this, it's only $9 a month, or just pay annually. I don't offer refunds on this, so make sure that you like it for paying annually, but it ends up being $90 for the year. And I give all kinds of data for it. It's not an alert service, but we give some trade ideas, which I haven't been doing many trade ideas this last week. I've been giving a lot of watch list updated charts this last week, but because of the volatility and the trend, I haven't been really adding too many there. I've been playing it kind of safe. I give monthly, quarterly expected moves, weekly expected moves, daily expected moves, and then the zones, which I'll show you. If you like my stock charts, I share permalinks to my stock market indicators there. Then you get access to the community as well. I wanted to share with you the zone visualization, which is basically, think of this as an advanced Bollinger Band. Advanced Bollinger Bands is what they basically are, but I extract the data into a visualization to really kind of quickly go through multiple assets to see what might be in a bullish trend, what might be in a bearish trend, and where main assets are. And I just wanted to call out that SPY, Qs, not really the Qs, IWM and DIA, so the Dow Jones, they're all nearing the lower range. And what I noticed is, from the band perspective, we've constantly been having lower lows these last, few weeks, we've been having lower lows each day. So yes, we're approaching the lower end, but what I'd like to see is the uptick in the lower end of the range as far as the numbers go, which I do share those numbers, but this is just a quick visualization. So this is not the area, like I said, I would want to be adding to shorts. This is the area where either I would be looking to play tactically long or wait for a bounce until we get into more of a bullish trend from the 15-minute perspective. One thing that I did call out today to the Discord group was this. I did notice that gold, so it is somewhat near its lower end of the range, and I'll show you a gold chart here momentarily. But if you did go back in the data, which is all there for anybody that wants to, you'll see that the lower level has been dropping. That means the lower level, which is this, as a band, right? It's been dropping straight, right? Basically for the last 11 trading days. But today, on today's down day, it actually ticked up as the price action was coming down. So this to me tells me that, hey, maybe perhaps we might be coming to an area now where gold's going to take a little bit of a breather to the down, stop moving to the downside, where we potentially might find some sort of a bounce. Now, that's not a guarantee, but that is just an observation and one to watch, as we still have 0.59% to the downside on that lower band. And when I take a look at the gold chart, you'll notice that, yeah, we've been kind of just moving down lower and lower. And the really big driver to this has been, well, the dollar, right? The dollar has been moving higher and higher. Go figure, right? The dollar gets more expensive and gold gets obviously less expensive, right? It moves down. And what I'll notice here from a technical perspective is price action had a lower low, and it's tagging down there too. And it's forming this wedge pattern, which, things move between expansion and contraction. They're getting tighter right now. So if we do, like we had this bottoming tail over here, but we never got above the high of it and around 1950 to start potentially seeing a bounce. So we saw more sell side take place. So if we start breaking out of this, it might be indication that we might get a little bit of a pop, which also could mean that the dollar, right, as it's nearing its upper range too, might be taking a little bit of a breather here in the near future, which could help perpetuate a move in gold. Now, if the dollar wants to continue to scream higher, buckle up, because obviously various assets that we previously discussed can obviously get hit. That's all I got for you on today's episode, everybody. It was a lot. Hope it helped out. See you later.